The moment most investors quit is usually the exact moment things were about to start working, not because they picked the wrong stocks, not because their strategy was flawed, and not because investing doesn't work, but because they reached a phase where the effort feels high and the results feel almost invisible. You're putting money in every month. You're trying to be consistent. You're doing what you're supposed to do, and yet nothing really seems to be happening. So you start to question it. Maybe this isn't worth it. Maybe there's a better way. Maybe you're just too late. And that's the trap, because right at that point where it feels slow, frustrating, and pointless, you're often much closer to progress than you realize. And the frustrating part is, you can't see this moment while you're in it. Today, I'm going to show you why so many investors quit at the worst possible time. We're going to break down what that moment actually looks like, not in theory, but in real numbers and real behavior. I'll walk you through the exact phase where most people start to doubt the process, and why that phase is often right before things begin to accelerate. We'll also look at the math behind why investing suddenly starts to feel easier after a certain point, even if nothing about your strategy changes. And most importantly, I'll show you how to recognize this moment while you're in it, so you don't walk away right before it starts working, especially right now, when markets feel uncertain and progress feels slow. My name is John, and I spend way too much time thinking about how people build wealth through investing, and why so many of them quit too early. If you're someone who's been trying to stay consistent, putting money away, but starting to question whether it's actually working, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Now let's take a look at what this quitting point actually looks like, because it's more predictable than people think. Most people don't quit investing randomly. They don't wake up one day and suddenly decide, this doesn't work. There's actually a very predictable timeline that almost everyone goes through. It usually starts with optimism. You open an account, you set up contributions, maybe you invest your first few $1,000s. And at this stage, everything feels right. You're doing something productive. You're thinking long-term. It feels like you finally started. But then you move into the next phase. And this is where things slow down. You're still contributing, maybe $300, $500, $1,000 a month. But your account doesn't really reflect that effort in a meaningful way. You check your balance, and it's slightly higher. Then the market dips, and it's slightly lower. Then it goes sideways for months. And over time, that initial excitement starts to fade, because now it doesn't feel like progress. It feels like maintenance. You're putting in effort, but the results don't match. And then something else usually happens. The market drops 10%, maybe 15%, or it just stalls for a long period of time. And suddenly, your account balance isn't just slow, it's unpredictable. Now you're not just waiting, you're questioning. Am I doing this right? Should I be investing in something else? Is this even worth it? And this is where it starts to break down, because what looks like random frustration is actually very consistent. If you look at when people stop contributing, when they pull money out, or when they abandon their plan entirely, it almost always clusters in this exact phase, after the excitement is gone, but before the results become obvious. Right in the middle, where it feels like the most effort for the least reward. And that's not a coincidence. That's the point where most investors quietly exit, without realizing what was about to happen next. Here's what most people don't realize. The reason this phase feels so frustrating has nothing to do with your strategy. It has to do with how investing actually works in the early stages. There's a mismatch between effort and visible reward. You're putting in consistent effort, adding money every single month, but the growth portion of your portfolio is still very small. So most of what you see in your account is just what you contributed, not what the market produced. Let me show you what that actually looks like. Let's say you invest $500 a month and you earn an average return of 8% per year. After the first year, you've contributed $6,000. Your total account value might be around $6,200. That's about $200 in growth. It's not nothing, but it doesn't feel meaningful. Now go to year 2. You've contributed $12,000 total. Your account might be around $13,000. So now you've gained about $1,000. Again, progress, but still not dramatic. And this is where the problem starts. Because from your perspective, you're doing all the work. The growth feels like a small bonus, not the main driver. So your brain starts to interpret this as, this isn't really working yet. But now watch what happens as time goes on. By year 5, you've contributed $30,000. Your account might be somewhere around $36,000. Now you're seeing $6,000 in growth. Better, but still, most of the balance came from you. Now let's keep going. By year 10, you've contributed $60,000, but your account could be around $90,000. Now the growth is $30,000. That's when something starts to shift, because now the market is doing a much larger portion of the work. And this is the turning point. This is the moment where growth starts to matter just as much, or more, than your contributions. But here's the issue. Most people never experience this shift, because they quit somewhere between years 2 and 5, right when it still feels slow, right when the growth hasn't taken over yet, right when the effort feels the highest relative to the results. And that creates a very misleading conclusion. They walk away thinking, I tried investing. It didn't really do much, when in reality, they left before it had a chance to work. This isn't a strategy failure. It's a timing illusion. In the early phase, your contributions dominate the account. In the later phase, your growth dominates the account. But if you leave before that transition happens, you never experience the part where it actually starts to feel easy. And from the outside, it looks like investing is slow and ineffective. But from the inside, if you stay long enough, it's a completely different experience. And this is where people get this wrong, because even if someone makes it past that early, slow growth phase, there's another trap waiting for them, and it has nothing to do with math. It has to do with timing and behavior. Most investors don't start at random points in time. They usually start investing when things feel good, when the market has been going up, when they're hearing about it more, when it finally feels like the right time to get in, which ironically is often near a short-term high. So what happens next? The market pulls back. Maybe it drops 10%. Maybe it goes sideways for a year or two. Maybe it just becomes unpredictable. And now the experience changes completely. Instead of seeing slow progress, you start seeing losses. Your account balance goes down, even though you're still contributing. And this is where the emotional pressure really builds, because now it doesn't just feel slow, it feels wrong. So people react. They stop contributing. They move to cash, or they pull out completely. And from their perspective, it feels logical. Why would I keep putting money into something that's going down? But here's the pattern that shows up over and over again. The exit happens during the dip. The recovery happens after they leave. And this isn't just a theory. There's actual data on this. Studies from firms like Dalbar have consistently shown that the average investor significantly underperforms the market, not because of poor investments, but because of poor timing. For example, while the stock market might return around 8 to 10% annually over long periods, the average investor often captures only a fraction of that. Why? Because they buy after growth and sell after declines. They miss the recovery. And the recovery is where a large portion of the gains actually happen. A few strong months, or even a few strong days, can make a huge difference in long-term returns. But those moments are unpredictable. They often come right after periods of fear and uncertainty, which is exactly when people are the least likely to stay invested. So what ends up happening is this. They go through the hardest part, the uncertainty, the decline, the doubt, and then they leave right before things improve. From the outside, it looks like bad luck, but when you zoom out, it's a very consistent behavioral pattern. The system itself isn't failing. The timing of the exit is. This is the part nobody talks about. There's a very specific moment in investing where things start to feel different. Not because you changed your strategy, not because you found a better investment, but because the structure of your portfolio has shifted. Up to this point, most of your progress has come from your contributions. You're the one doing the heavy lifting. Every increase in your account is mostly the result of money you added, not what the market produced. But then something changes. Gradually, and almost invisibly at first, your returns start to matter more. You might still be contributing $500 a month. That hasn't changed. But now your portfolio might be generating $600, $700, sometimes even $1,000 in growth over the same period. And that's the turning point, when your returns start matching and eventually exceeding your contributions. The entire experience shifts, because now, even if you did nothing for a month, your portfolio would still grow. And this is where investing starts to feel easy, not effortless, but different, less dependent on your input, more driven by what you've already built. And the psychological shift here is just as important as the math. Before this point, you're constantly questioning, is this working? Should I be doing something else? Why does this feel so slow? But after this point, the doubt starts to fade, because now you can actually see the system working. The growth becomes visible, the progress becomes measurable, and your confidence starts to replace uncertainty. A good way to think about this is like pushing a heavy boulder uphill. At the bottom, it's slow. Every step takes effort, and it barely feels like it's moving. You're doing all the work, but once you get it over the top, it starts to roll on its own. Now your role changes. You're not pushing as hard, you're maintaining direction. And here's the problem. Most investors quit when they're still pushing uphill, right before the point where the momentum would have taken over. They never experience what it feels like on the other side, because that turning point is quiet. There's no notification, no clear signal, no moment where it announces itself. It just happens, gradually. And if you leave before you reach it, you walk away thinking the process never worked, when in reality, you were right on the edge of the part that does. Let's look at what happens if you quit versus stay. Let's take the same example. You're investing $500 a month at an average return of 8%. After about 4 years, you've contributed roughly $24,000. Your account might be somewhere around $27,000 to $29,000. There's some growth, but it's not dramatic. This is exactly where a lot of people stop. It feels slow. It feels like a lot of effort for not much return, and they decide it's not worth continuing. So they quit, they withdraw, or they stop contributing, or they shift strategies entirely. And from that point forward, the system resets, because investing only works when time compounds on itself. Now let's look at the alternative. Same person, same contributions, same return. But instead of stopping at year 4, they stay. They keep going to year 10. Now they've contributed $60,000, but their account might be around $90,000. That's a $30,000 difference created by growth. And then they continue to year 15. Now they've contributed $90,000, but their account could be around $170,000 or more. At this point, growth is doing more work than they are, and the experience feels completely different. But here's the key insight. The person who quit at year 4 didn't fail. They didn't make a bad decision. They just stopped at the exact point where the system hadn't revealed its full effect yet. They were still in the phase where effort dominates. They left right before growth takes over. You weren't early, you were almost there. And that's what makes this so frustrating. Because from the outside, both paths look similar in the beginning. Same contributions, same slow progress, same uncertainty, but over time, they separate dramatically. And that separation doesn't happen at the start. It happens later, which means if you quit too soon, you never see the part where it actually becomes worth it. Here's the dangerous assumption. Most people think they quit investing because of logic, because the returns weren't good enough, because the market was too risky, because something wasn't working. But in reality, most people quit because of pressure, not financial pressure, psychological pressure. First, there's boredom. Investing, especially long-term investing, is repetitive. You contribute, you wait, you check your account, and not much changes. There's no excitement, no big wins, no immediate feedback. And over time, that lack of stimulation makes it feel like nothing is happening, even when progress is quietly building. Then there's the lack of visible results. You might be doing everything right, but your account doesn't reflect it yet. So it creates this disconnect. Effort is high, results feel low, and your brain interprets that as failure. Then comes comparison. You see someone making money in crypto, someone flipping real estate, someone talking about a stock that doubled in 6 months, and suddenly, your slow, steady approach feels like you're falling behind, even if you're not. And then you add in the news cycle, headlines about crashes, recessions, uncertainty, constant reminders that something could go wrong. And all of this builds pressure, not all at once, but gradually, until eventually, it feels easier to stop than to continue. Now, you might be thinking, what if the market crashes? And that's a fair concern. Markets do go down. But historically, those downturns are part of the process, not the end of it. They're temporary phases inside a long-term trend, and often, they're the exact moments that set up future growth. Now you might be thinking, what if I'm doing this wrong? And that's also valid, because there are bad strategies. But the scenario we're talking about here isn't about someone making random decisions. It's about someone being consistent and still feeling like it's not working yet. That's the key difference, because if you're following a sound approach and you're still early in the process, what feels like failure is often just delay. And when you combine boredom, comparison, and fear, that delay becomes very hard to tolerate, which is why so many people step away right before the system starts to prove itself. This changes how you look at investing, because the difficulty isn't constant. It doesn't gradually get easier in a straight line. It actually feels hardest right before it starts to work. And the reason comes down to a simple mismatch. Your effort stays consistent. You're still investing the same $500 a month. You're still showing up. You're still doing what you plan to do, but your results don't scale at the same speed. In the beginning, growth is small. So even though you're consistent, the output doesn't reflect it yet, and your brain interprets that delay as failure. It assumes, if this was working, I would see it by now. But investing doesn't reward you evenly. It delays the visible payoff, and then, later on, it compresses a large portion of the results into a shorter period of time. So what happens is this: right before that acceleration begins, you've already put in years of effort. You've already been patient. You've already waited longer than most people expect to wait. And yet, the results still feel underwhelming. That's when frustration peaks. Not at the beginning, but after you've been consistent for a while. After you've done everything right and still don't feel rewarded. And that's exactly why people quit there. Because from their perspective, they gave it a fair shot. But from a mathematical perspective, they were right on the edge of the phase where everything starts to compound more visibly, where growth begins to catch up to effort, where it finally starts to feel easier, and the system hasn't failed them. It just hasn't revealed itself yet. So the question becomes, how do you make sure you don't quit at this exact moment? Because the problem isn't just understanding this, it's staying in the game long enough to experience it. Here are a few practical ways to handle that. First, calculate your break point. This is the point where your portfolio's growth starts matching your contributions. If you're investing $500 a month, that's $6,000 a year. So the question is, at what portfolio size does an average return, say 7 to 8%, generate around $6,000 per year? That happens somewhere around $75,000 to $85,000. That's the level where growth starts doing as much work as you are. And once you know that number, the process becomes clearer. You're not just investing randomly. You're working toward a specific phase shift. Second, automate your contributions, because consistency matters more than intensity. If you rely on motivation, you'll stop during the exact periods where this feels hardest. Automation removes that decision. It keeps you moving forward, even when your confidence drops. Third, avoid checking your account too frequently, because short-term fluctuations distort your perception. If you're looking at your portfolio every day, you're going to experience noise, not progress. Zoom out. Monthly or even quarterly is enough. That gives the system time to actually show movement. Fourth, track long-term metrics instead of daily balance. Look at things like total contributions, total growth time invested, because those tell a much more accurate story than a number that moves up and down every day. And finally, set a minimum time horizon, not a goal, a commitment, something like 10 years, not because something magical happens at year 10, but because it forces you to stay past the phase where most people quit. It pushes you beyond the slow, frustrating middle, and into the part where the system starts to become visible, because the real advantage in investing isn't picking better assets. It's staying long enough to let them work. So if you fast forward a few years, the version of you that didn't quit looks very different, not because they found a secret strategy, not because they timed the market perfectly, but because they stayed. Their portfolio is no longer something they question every month. It's something they trust. Growth shows up without constant effort. Progress feels steady instead of uncertain, and decisions become simpler, not more complicated. That's the shift. It's not about getting rich quickly. It's about reaching a point where your investments start creating options. The option to work less, the option to take risks in other areas of your life, the option to not feel pressure every time something unexpected happens. And none of that comes from doing something extraordinary. It comes from not interrupting the process right before it starts working. Because staying, when it feels slow, when it feels uncertain, is the advantage. That's the part most people underestimate. So I'm curious, comment how long you've been investing and whether you've ever felt like quitting during that slow phase. Because chances are, you were closer than you thought. My name is John, and I'm not a financial advisor. This video is for educational purposes only. Always do your own research and make financial decisions based on your individual situation. Everything discussed here is meant to help you think more clearly about investing behavior and long-term decision-making, not to provide specific investment recommendations. Your situation is unique, and what works for one person may not apply to another.